to go back to screen share and put up some information and say we're looking from the beginning of this idea of tax as a second language. And in this presentation, you will hear about filing status, standard and itemized deductions, things called tax credits, which can be very financially a good thing, withholding, building savings at tax time, and perhaps most importantly, how to file your tax return for free. So if you need to file a tax return and you learn nothing more than what I'm about to tell you, the takeaway is you should be able to get your tax return filed free of charge. So let's plunge right in, and I will encourage folks to unmute or just ask a question as well as use the chat, but we want to make sure that this is more of a conversation. It will be about an hour, and we'll learn about different aspects of tax language. So the first question is this thing called filing status. And there are different filing statuses depending on, well, a number of factors. And one of the confusing things, it took me a while to learn this. Filing status sounds like marital status, but it's not exactly. When we think of someone who is single as a marital status, that generally means that they've never been married. You'll notice there's no filing status called divorced, but if a person is not married and has no, let's say, children to claim or what are called dependents, people depending on you, that is the filing status of single. Head of household is usually a single parent, that is someone who's not married but has one or more children, or it may be that they're taking care of mom who lives on her own, and the taxpayer is paying the rent for mom and is otherwise supporting her and is able to claim this head of household filing status. Most people who are married will choose to file married filing jointly. The couple will file one tax return for the two of them. Now, there are some times when someone will be filing married filing separately. Now, they're still legally married. They may be going through a divorce and want to protect their own finances, or they think their spouse may be engaged in some financial shenanigans, and they want to also protect themselves from what might be considered criminal behavior. Now, qualifying widow or widower, no one wants to qualify. No one wants to lose their spouse, but the IRS has special rules for what to do when a spouse passes away. And so let's look at calendar 2022, which is still underway, but we're talking about after the first of the year, people will file their tax return in the early part of 2023 or 2022. And in some cases, it may be a widow, or a person whose spouse died during calendar 2022. Now, the IRS figures, and there's some logic to this, that person, that spouse who died also lived during 2022. So the question is, for the previous year, when the couple was still together, both were alive, did they file as married filing jointly? And if so, the widow or widower is able to file one return and claim the married filing jointly filing status. Now, why is this important? It has to do with something called the standard deduction. Let's take a look at that. Now, there are, as we said, 5 filing statuses, and for a couple, it's married filing jointly, or, and here's where we see that, qualifying widow or widower, they can claim a standard amount of $25,900 that they can subtract or deduct from their total income. So they're paying tax on a much lower amount. Does that make sense? Now, a single person or someone who's choosing to file as married filing separately can claim a standard deduction of $12,950. And right in the middle, that head of household is $19,400. So right away, you can see there's some interesting language there. If you read the word standard, you might think, doesn't that mean there's one standard? Well, no. As you can see, there are 3 different standard deductions, depending on filing status. And oh, by the way, for people who are older than 65 or who are blind, there's an additional amount. So there's really more than one standard deduction. If you have any questions, speak up. I'm happy to try to explain that for you. I'm not an accountant, which probably gives me an advantage in this discussion because I can speak English as well as having spent a lot of time trying to understand this tax language and make it understandable for just regular folks who are filing a tax return. Now, you may have heard the term itemized deductions. What does that mean? Well, there are certain items that the Internal Revenue Service, the IRS, says can be deducted from your income. So it applies mostly to homeowners. So you can see the mortgage interest that someone pays can be deducted. Real estate taxes, that's what's charged by the city or town. Property taxes, that's the city or town amount for car registration. Certain amount of medical expenses above a certain income level, and contributions, donations that are made to charitable causes, and some other things as well. But if those items add up to more than the standard amount for your filing status, you can claim the larger itemized deductions. For most people, the standard amount, the standard deduction will come into play. Questions? I'm going to pause at every time we have a change of slide and make sure people are understanding, are nodding their heads. All right, let's move on. So there's this thing called withholding. What do we think we mean by withholding? There's some
Gary?
money. Yes?
Oh, Gary, sorry. I do have a question if that's okay.
Yes, absolutely.
Gary, sorry. So with the charitable donations,
Yes.
my husband and I, this is a small question, but we go round and round. Like when we donate items, he likes to take a picture of everything and describes it, like has a whole worksheet. Is that actually necessary? Because it slows the whole process down. I'm like, oh no, just, you can be more vague, but yeah.
Yeah, the worksheet is good because I assume you're talking about clothes donated to an organization like Goodwill.
That's one of the things, yeah.
Okay, as opposed to cash donations.
Yeah, no, not yes, cash. We do that, but I'm talking more of like items, like household items or
Sure.
clothes or something.
Yeah, what you can do is do that worksheet and try to estimate the fair market value of those items.
Okay.
So, a pair of pants might be $2, a shirt might be $1. I'm making numbers up. If there are other household, kitchen items that you're donating, map it out, total it up, and prepare a letter. And then you can get a signature from the recipient organization. And, they may or may not agree with you, but they'll say, this is to verify that you made a donation, called an in-kind donation because you're contributing goods rather than cash, and the dollar value is this. And again, you can only itemize if you can only claim charitable donations as a deduction if you are itemizing.
Okay, thank you.
You're welcome. Now, withholding is something most folks who are working will do by signing up with their employer. They'll fill out a form W-4 and say, I want to have some money taken out of my paycheck. And the reason for that is, it's like paying your taxes on layaway. There are some stores where if you're making a large purchase, you go into the store and you put some money down a little bit at a time. And over the course of some months or a year, it adds up so that you're not having to make the large payment all at once. Taxes is kind of a similar thing. You're putting money aside. You're loaning the government your money, but it's adding up to an amount that is designed to pay your tax bill. And we'll get to that tax bill in a minute. But understand, the more withheld, the smaller your paycheck, the less withholding, more in your paycheck. So you want to have just enough taken out of your paycheck to pay the tax bill. Now, for folks who are self-employed, please understand that there's no HR, you're HR. So you're going to have to be setting aside some money yourself, and you can do that. And most folks who are self-employed, they have a side gig doing, any of a number of wonderful things, crafts, or they clean houses. They drive car delivery or food delivery, for example, or they may be full-time, but they need to make sure that they're putting aside enough in withholding to pay that. Now, it can be, if you're also working, you can increase your withholding from your job to cover that withholding from the side gig. But if you have at least $400 in self-employment income, the tax will kick in, the self-employment tax, because people who are working for someone else pay a portion of their income for Medicare and Social Security. And what you may not realize is that's only half of the total amount. For people who are employed, the employer pays the other half. For self-employed people, well, you're paying both halves because you're the employer as well as the employee. So you need to make sure that you're having enough taken out to cover the check, but you also need to make sure you're not having too much taken out, because that is kind of depriving you of money all year long. You want to have just enough taken out so that it meets the tax obligation. And if you want to try to figure that out, there's a tool on the IRS website, irs.gov. There's no place to click on it. You'll just type in the search box on the upper right corner, withholding estimator. And you'll need last year's tax return and your most recent pay stubs and any other information. So if you have more than one job, if it's a married couple and they have 2 jobs, and maybe one of them has a side job as well, it's important to have all of that taken into account. If you're already receiving tax credits, you'll see that on the tax return, and we'll talk about what some of them are. And this will determine if you want to make a change with your employer by filing a new form W-4. So you fill out a W-4 and you tell your employer this is how much to withhold. And if there's been a change in your home situation, if you've gotten married, if you've gotten divorced, if you've had a child, if you have a child who has reached young adulthood and has moved out of the house, all of those things affect your taxes because there are tax implications for all of those family situations. What you will find is this tax code that can be kind of complicated basically reflects life, which can also be complicated. So here's some more language for you. One of these is not like the others.
Hey, Cary, we have a quick question.
Yes.
It's Wendy again. I have another question.
That's
So
fine.
what's the best way for, like, my husband and I have always been just self-employed. Me working for the Institute is a new thing for me. So what would be the best way? Because we do struggle with that, like, as far as withholding, to not have a huge tax bill at the end.
Yeah.
So if you've already sort of been entrenched with being your own employer, like being self-employed,
Yes.
you just go to the irs.gov and fill out paperwork to almost like you're doing like a new W-4 for an employer or something.
Yeah, there's a couple of ways to do it, Wendy. As I say, you can use the withholding estimator, which is a little painstaking, but it's something that you can do at home. A lot of people don't like to do a new W-4 with their employer if you don't want to show them all of your information besides the one job, right? So the IRS doesn't really care whether you have larger withholding from the job and no money set aside from the self-employment, or whether you keep the amount of withholding from the job and make it a point to set aside more money through the call it estimated quarterly payments over the course of the year for the self-employment. They just want their money, and if it adds up, you're fine. But particularly people who are self-employed, I strongly encourage folks to make sure that they're maybe putting a little extra into withholding, because unless Yeah, I mean, let's think of what happens at, at tax time. Let's stay with this question because, it can be one of the most traumatic moments when someone realizes they have to pay in. And you know what? It's really not. If you have just a little bit to pay in, if you've got that money in the bank, you're okay. If you've got a larger amount that you need to pay in, again, not the end of the world. It's a reason for filing fairly early in tax season. Even if you've got that self-employment, you've got to take a little time to put all your things together, the receipts from any expenses that you can take. If in doubt, bring it to the tax preparer, and we provide free tax filing in most cases. But we can go over it, and let's say it's the middle of February and you find out you owe, $1,000. That may be a shocking amount. It may be more than that, but the tax is not due until, well, this year, April 18th. So you can file the tax return now and start setting aside money. And so pay as much as you can on or just before April 18th, because if you still owe money after that, there will be penalties and fines, but it's only on the amount owed on April 19th. So if you can, live on ramen noodle for a couple of months and be able to file, make that payment and get it all done, good for you. Make some adjustments right away so that you're putting aside more, maybe through those quarterly estimated payments. And if there is an amount still due and it's significant, you can make a payment plan with the IRS. You can make monthly payments, usually up to, I think, 120 days. And, it's fair. You can put it on a credit card, although that's very expensive. I just want to let you know that. But there are a number of places in the community that you can actually go. Just as there are places where people can cash a check, you can actually pay your tax bill at 7-Eleven.
Okay.
So they're a national company with a contract with the IRS to allow you to do that.
Well, thank you very much. Thank
You're
you.
very welcome. Yeah, my take on things, many people think the big refund is like this windfall, and that's really not the best situation. I would say the best situation is to come out as close to zero as possible, because that means you're having all of your income working for you. So that's something that you want. Remember, we said, the more withholding, the less in your paycheck. But the less withholding, if it's enough to pay the bill, you'll have more money in your paycheck throughout the course of the year to keep up with bills and maybe put money in savings. And that's really what we want. I think the next best situation is to get, a little bit back. A couple $100 is a nice little windfall that you can, have some fun with. The next situation is to have, a lot back means that you've been tying up too much of your money during the course of the year. And then the worst situation, obviously, is to have a large tax bill at the time you file your return. So, that it's not such a bad thing to have, a little bit owed. I remember one year I owed $52 and had more than $52 in the bank. In fact, made more than $52 in interest. So that's the example of having your money working for you. I just sent some of my interest to pay the tax bill. Other questions, comments? All right, let's move along and to look at some language. So we talk about subtracting money from your income, because if you just had the total amount that you made and had to pay a tax on it, it would be more than if you are able to do these things called adjustments and deductions. Remember, we talked about the standard deduction versus itemized deductions. Adjustments are just like deductions, but they're for people who don't necessarily, you don't have to itemize in order to claim them. So school teachers who pay money out of pocket because the schools just don't have the budget, and they should, but making teachers who don't make enough to begin with pay money out of pocket for school supplies. Well, the IRS says, tell you what, we're going to give you a $300 adjustment. And that's an income from increase from last year. People who have school loan debt, they can claim a deduction or an adjustment actually on the interest on their student loans of up to $2,500. If you put money aside in a retirement account, an IRA, individual retirement arrangement, that's considered pre-tax. So the amount you put into that account can be an adjustment as well. Now, credits are different in that they're not a subtraction. They actually pay the tax bill directly. And so that's the best thing if you qualify for one or more credits. And we'll look at those momentarily. But we want to say, okay, let's try to make this a little simpler. I have this thing called a tax return. It's the document that I fill out. I've chosen my filing status because that guy who talked to me that evening told me more about how to claim the correct filing status and the standard deduction. But first I take my income, add that all up, subtract adjustments, and I have something called AGI, adjusted gross income. Now, at the International Institute, you may be working with clients who qualify for fuel assistance. It's important that they know that their fuel assistance is based on their adjusted gross income. So it's more than simply use that tax time. They can bring their tax return to the Community Action Office, Southern New Hampshire Services, to complete their application for fuel assistance, and the AGI will verify that income. And then we take the deductions, either standard or itemized. So the AGI, the adjusted gross income, minus deductions equals the taxable income. So it's not tax on the full income. You see that? A portion of the taxable income equals the tax bill. So it's a percentage. And withholding is put toward the tax bill. So if you have got withholding that equals the tax bill, it pays it down to 0. If you put in more than in withholding than the tax bill shows, then you get some money back. That's called a refund. If you haven't put enough in, you've got what's called a balance due. But there are also these credits that can pay your taxes. And I understood it was getting with kind of really confusing for folks. So I figured out that people go shopping more than they pay their tax, more often than they pay their taxes. So to think of a credit as like getting a gift card for your taxes. And so you're working and you are filing your income taxes, whether it's in person or online, at the tax store, right? And they tell you, oh, Heidi, you've been a good customer here at the tax store. You qualify for a rewards program. You have one or more credits that we'll talk about that you qualify for and can use that, pay it toward your taxes. So anyway, withholding can be reduced. In fact, the credit can pay the full amount of the tax bill and sometimes even give you a refund from that. So in that case, there would be no reason to have anything withheld. So getting back to that withholding estimator, it might be that if you're getting a refund because the tax credits pay all your taxes, no reason to have anything withheld. So let's look at an example. Dominique is a single parent with 2 children, ages 8 and 10. Dominique's, it's early 2023. Dominique is going to file her tax return. Her total income for 2022 was $21,900. And there's a reason that I chose that particular figure. You'll see it in a moment. So remember I said there are these things called adjustments. Let's say Dominique had gone back to school, took out a student loan. She may or may not have finished her education, but she's still got that student loan that she's paying on. And she's got interest on that loan. Let's say it added up to $2,500 or more. The maximum adjustment for the student loan interest is $2,500. So we take the $21,900, we subtract that one adjustment, and now her adjusted gross income is $19,400. But wait, we haven't taken her standard deduction, have we? So we said Dominique is a single parent. Do we recall what filing status that corresponds to? Anyone? Well, it would be the head of household. And that amount for 2022 is $19,400. What do you know? We subtract $19,400 from $19,400, and what do we have? Her taxable income is zero. So what do you think the tax is on zero? Come on now. Anyone? Bueller? There's no tax on zero income.
Should be zero.
Correct. Yeah, there's no tax on zero. Now, if she had just the income and had to pay taxes on her full income, even at 10% of 21,000, more than $21,000 would be more than $2,000. Now, would you rather pay $2,000 in taxes or zero in taxes?
I
Zero.
want to play zero taxes.
Yeah, it's not a trick question. So that's where you can see there's a little work involved in figuring out the difference between the income and the taxable income. But as you can see in Dominique's case, it really worked to her advantage. Let's talk about these things called tax credits. Remember, I said it's like a gift card to pay your taxes, and there are different types of credits. I'll go through kind of a menu here, and then we'll break them down a little bit. One of the biggest credits that we want to talk about is the earned income tax credit. The amount for someone with 3 or more what are called qualifying children lived with you for most of the year. Doesn't have to be your child. It could be grandparents raising their grandchildren who are working can claim the earned income credit. And the maximum payment is, as you can see, nearly $7,000 for 2022. And I say that for these numbers are adjusted annually every year. The earned income credit is increased by a certain amount. The eligibility is increased, and the standard deduction are also numbers that are increased, but they stay pretty much the same in tax law. The child tax credit is one that people can claim if they have a child that they're supporting who is 16 or younger. If the child is 17 or older, but still living with the parents or caregivers or filing a tax return, they can claim what is called a credit for other dependents and still get $500 toward their tax bill. Education expenses, for those of you who may have thought about going back to school yourselves or have a child who is college age, there are certain credits that are available to help pay for your education. And that's up to $2,500 for each of 4 years is the maximum. So that's $10,000 over 4 years toward college expenses. And that's enough to, help reduce the amount that someone has to take out as a student loan. There's a credit for people who have a retirement account and put money into that account. It can be up to $2,000 for an individual, up to $4,000 for people who are married, filing jointly, and for people who have an ABLE account. These are people who have a disability. They qualify under certain circumstances for an ABLE account that allows them to put money aside without running the risk that they will have too much in an account that might disrupt their disability benefits. And the premium tax credit is also still around. It's to help people who don't have an offer of health insurance from an employer, and so it can help pay their health insurance. Let's move on to talk about the earned income tax credit. It's one of the biggest in terms of how much it pays for folks. What a lot of people don't realize is eligibility begins with the very first dollar of earned income. So we know that there are some people who don't file a tax return. Remember I mentioned those standard deduction amounts? Well, that's also the tax filing threshold. So if someone has earned income less than that, so a single person, no children to claim, their income is less than $12,000, they're not required to file a tax return. However, the only way they can claim that earned income credit is if they file a tax return. So they may have, $6,000, $8,000, $10,000 from, part-time jobs, self-employment that added up. They should file a tax return, even though they're not required to, because the only way they can get that earned income credit is to file a return. And there are many people who do not file. They're missing out on a lot. The earned income credit, here's another piece of language for you. It's refundable, which means that the amount on that gift card after the tax bill is paid is refunded. So remember I said, the earned income credit can be almost $7,000. Let's say someone has $6,000 for an earned income credit, which is based on the number of children that they have and their earnings for the year. But their tax bill is $2,000. So the first $2,000 of that $6,000 credit pays the tax bill down to zero. The $4,000 is refunded. So there's no reason in that case to have any money withheld, because you're getting a $4,000 refund and still having the opportunity to hang on to all of the money that was in your paycheck throughout the course of the year. That's the magic of refundable tax credits, and that's really what we want to look at. What we also know is that the IRS, the Internal Revenue Service, estimates that as many as 1 in 4 people do not claim the credit. I did the math, and based on the numbers of people in New Hampshire who are claiming the credit, I said, what would an additional 25% look like? And I figured it based on the average credit that people in New Hampshire are claiming, and found that there's somewhere north of $36 million left unclaimed by people here in New Hampshire, our small state, who could really use that money. And so they fall into several categories that we've only learned about from helping them, and they come to the site. There's no Facebook group called people who are eligible for the earned income tax credit but don't claim it. There are people who have a disability benefit. And someone like the person here using the wheelchair, who's able to work, but is very scared that she might lose her disability benefits because of something called the benefits cliff. If someone makes too much, they might lose their benefits. They fall off the cliff. But the earned income credit is a guardrail against the benefits cliff. Also, family members who take care of someone with a disability need to know that if that person is permanently and totally disabled, there's no age limit. Normally, when someone is claiming a child for the earned income credit, the age of the child must be younger than 19 or 24 if that young adult child is still in school full-time and living with the parents and they provide this support. But for someone of any age, and it doesn't even have to be a parent. We had one case that was really heartwarming of a woman who came to one of the free sites that we run, and she had a younger sister. They were both in their 30s. The woman had never claimed her younger sister, who lives with her, and the older sister provides all the care and all the support. She had done her own taxes for several years and had gotten a refund of about $1,000. She came to us and said, if I did this right, I should be getting $1,000 back. Well, our volunteer tax preparer at the site saw on her paperwork, she had written down that she's the caregiver for her younger sister, who was permanently and totally disabled, and asked if she'd ever claimed her before. And she didn't know that she could. And that's part of the reason some people don't claim. So we did her current year's return, and then we amended. That means we went back 3 years and made changes to those returns that had been filed 3 years previously, 2 years and 1 year previously, and made a change to include the younger sister, claiming her for the earned income credit. Let me take a sip of water while you ponder what that meant. What do you think her refund really was? The $1,000 she was expecting became $10,000. And our volunteer got the greatest payment that we can ever get, a hug from a grateful volunteer, taxpayer who we've helped in that regard. Remember, I said people who have very low income, below the filing threshold, they may think, I don't have enough to file, so I'm just not going to bother. Kinship care providers, typically grandparents raising their grandchildren. We hear a lot about that. Or foster parents. Again, they're not the parents, so they think they can't file to claim the earned income credit. Or there are people who think they need a child to claim, and there is a small earned income credit for people who are working however, do not have a child to claim. Now, there were changes this year to the earned income credit. Filers without a child to claim must be between the ages of 25 and 64. Now, that's a change from last year when that age restriction was relaxed under the American Rescue Plan Act, and it allowed people 65 and older without a child to claim to get the earned income credit. And for folks as young as 19 who were just starting out could get the earned income credit. That went away at the end of 2021. So the change for this year is that filers without a child to claim must be between the ages of 25 and 64. I'll leave that out there. There may be some folks who did claim the credit last year who may be in for an unpleasant surprise. So that's why I'm putting it out there right now. And so, International Institute folks, you work with your clients, make sure that, if they fall into that age situation, that they're aware of the change there. Now, the child tax credit got a lot of attention last year. But unfortunately, similar to the earned income credit, the enhancements that made it a larger amount and produced, remember those folks who have children received advance payments monthly for the last half of 2021. You might have noticed you're not getting those payments right now because they went away. Now, the amount of the credit was reduced from $3,000 in 2021 to $2,000 per child 16 and under. So the child must be under the age of 17. That's a year younger than it was before. And the amount that is refundable is $1,500. And then finally, there must be earned income of at least $2,500 in order for folks to claim a child. Questions about that? All right. I hope no one is shocked by that. And I hope no one is losing out, but we know that some folks who have children will be losing out. Now, the Affordable Care Act is, as I mentioned, the way that people can claim health insurance if they are of working age. They're under 65, which is the age for Medicare. They do not have an offer of employment of healthcare from an employer, rather. So they can go to the marketplace where they can get coverage that may include a subsidy that helps pay for that health insurance. And that's called the premium tax credit. Now, for most people, they will pay that premium to have the premium tax credit as an advance payment made directly to the health insurance provider, so that the amount that they have to pay is significantly lower. And then at the end of the year, they claim they'll get a form from their health insurance provider, just as those of us who are working get a form W-2. People with marketplace coverage will get a form 1095A. And what that will do is to reconcile the amount of credit that they receive with the amount that they should have received. Because when they filed for marketplace coverage, they were estimating how much money they were going to be making for the year. And that was more than a year out. So right now, just think of it. The open enrollment period for marketplaces is right around now. I think it's early December. So people are having to make change estimates on how much they're going to make for 2023 to get coverage in 2023. And then they will, in this case, reconcile that a year from now, 2024. So things can change. And sometimes people will get have a change in their income and they don't necessarily report that to the marketplace. And that can really come to bite them when they go to do that reconciliation. Now, the good news is there's no shared responsibility payment enforced for people who don't have coverage. The bad news is if you don't have health insurance coverage, it can be very expensive. But the Affordable Care Act can make it less expensive. It makes it affordable. And there's some a tax credit that people have received in advance. The Retirement Savers Credit has become one of my favorites. The people who receive it sometimes do it by accident. They signed up for a retirement plan at work, or they signed a bunch of papers that included a retirement plan. and there's money that they're having taken out of their paycheck and put toward that retirement plan. Now that's called pre-tax contribution. So it's like a deduction, but it's taken through your paycheck, and that it reduces the amount of taxable income in the short term. And the amount of the credit is from 10 to 50% of your retirement contribution. So if someone is able to put $4,000 of their pay into retirement over the course of the year, depending on how much income and how close it is to those maximum amounts that you see there, someone who's close to the maximum amount will get a smaller portion, or 10% of what they paid. So 10% of $4,000 is $400 to put toward the tax bill. Not too shabby. However, if they are really low income, there's a much greater incentive, and that is that they can get up to 50% or half of that $4,000, which is $2,000 toward the tax bill. ABLE accounts qualify. So for someone who has either a Roth IRA or an IRA, individual retirement arrangement, they can still get that toward the their tax bill. And most importantly, it's more money available to you when you retire. A little confusing, but does it make sense to folks? It's the only double benefit of the tax bill. You know, if you have a 401k or a 403b at work and you're contributing into it, that gives you the tax deduction. The same with a traditional IRA. So that's one benefit. But then the second benefit is that if you qualify by income, $66,000 for married filing jointly, half that for a single person, and that middle amount for a head of household, they can get an additional tax credit toward their tax bill. Now that credit is not refundable, so it can pay up to the amount of the credit, up to the amount of the tax bill. If there's anything left on that gift card, that money just goes away.
I guess I don't quite understand. Hi, I'm Tim, by the way.
Okay. Hi.
I don't quite understand when you say more money when you retire. Are you just talking about the retirement saving itself?
Yeah, it's giving you incentive to put more money in retirement savings. So, you know, we're able to say to someone, hey, you know, look at how much of a retirement savers credit you got just by what you signed up for at work. You know, if you were to increase your payment, you know, contribution by 10%, you would wind up with more of a deduction in the short term, maybe more of a credit. And then, you know, that extra $10, you know, times every pay period for so many years would add up to, you know, good old compound interest is our best friend. And that's, you know, that's what I mean by more money when you retire. Does that make sense?
Makes sense.
Okay.
Thank you.
You're welcome. Let's move on to the opportunity to build savings at tax time. You know, there was a study by the Federal Reserve that asked people of all income levels, could you withstand an unexpected expense of $400 or more without having to either borrow or sell something? And as I said, it's 1 in 3 people around the country of all income levels said, no, I'd have to sell something or I'd have to borrow money. And so, you know, $400 is not even 1 month's rent, folks. So to say, gee, if that sounds like you, might this be an opportunity, if you're getting a significant refund, to put some money into savings? So you can do that by adding one form to your tax return. And it's called the allocation of refund form. There's space on there for up to 3 different accounts. So typically, you know, checking, savings, most folks have one or both. Many people have both. And we typically hear at tax time, you know, that money's coming into my savings account, or my checking account rather, and it goes right back out again because I've got bills to pay. And I've got, you know, very little in savings, but, you know, is this an opportunity to split off that? You know, does that sound like you, that, you know, $400? And if someone went to one of those commercial tax preparers, they may have paid $200, $300, $400 to get their refund and, you know, get a chunk taken out of it. Here, you get all of your refund if you go to one of our free sites that I'll talk a little bit about and pay yourself instead of paying a commercial preparer. You can use direct deposit, which means the money goes directly into one or two or three accounts. And you can also buy a US savings bond with a portion of that refund that's on the same form 8888. There's space where you can buy one for yourself, buy one for somebody else. I had one non-custodial parent who had two children. He bought savings bonds for each of his two children, and really enjoyed living up to his role as a dad. I have the latest information from the U.S. Treasury Department. It's the Series I bond, which is an amount. There's an amount in savings that, or the interest rate adjusts every 6 months. So on November 1st, it was adjusted to 6.89%. So you have to put that aside for at least a year, but it's as little as $50, could be as much as $5,000. Great, not for everybody, but a great way to build longer term savings that's guaranteed. It will never go below zero, as some investments do, and it will always be adjusted for inflation. Oh, by the way, you can also get a paper check. So for someone who may have, just no bank account, but they want to buy a savings bond, they can get, most of it as a paper check, and the other can be put into the savings bond. And it's the paper bond. It's the last place in America that you can get a paper U.S. savings bond. Questions about building up your savings at tax time? Short and long term. You can buy the savings bond for someone else. We've seen it's popular among grandparents who can buy a savings bond for their grandchildren. And I mentioned free tax preparation. So we have statewide sites that we are organizing, and IRS certified volunteers. We're going through the training and certification right now, so they'll be all ready when tax season opens in late January. And they're volunteers. They're going through a training process that we didn't write. The IRS provides the certification. Folks are volunteering their time. You can jot down 211, our statewide information and referral line that is available year round for all sorts of things. And you can also, call and find out where is there a tax site near me. I can tell you that we're standing up a VITA site in Manchester that will be operating on Saturdays at the Manchester Police Athletic League, and then 2 evenings a week, Tuesday and Thursday, at Amoskeag Health. So free tax preparation through IRS certified volunteers. There's also going to be a site on campus at Southern New Hampshire University. And our friends at AARP Tax Aid also will operate one or more sites. We're still finalizing that. So wait until January to call, or you can go to nhtaxhelp.org and see the complete list. For folks who file on their own, we want you to know about myfreetaxes.com. It is free of charge. You'll go in there, create an account. You'll get guidance on questions that you may have, and still waiting to hear, but we're hopeful that there will be live telephone assist. So you can call a toll-free number, and if you're using My Free Taxes, you can say, hey, I learned about this thing called the Earned Income Tax Credit. What is it? And do I qualify? And if I do qualify, where in the heck do I put it on my tax return? They can help you through all of that. I'm going to leave that up for a moment. That's our little plug to say, we want to see as many of you as possible coming to our free tax preparation sites. But of course, I mentioned IRS certified volunteers. We need volunteers. We're looking for people who can to greet people at the door, allay their concerns if they're a first-time person coming to get their taxes done. IRS certified volunteers will be preparing your return, Mr. or Ms. Taxpayer, but we want to make sure you've gone through your paperwork, that you have everything you need for a complete return. People can put a little more time in if they're not scared of filing taxes. They file their own. If they're computer savvy and not math phobic, we are looking to talk to you about being a tax preparation volunteer. We'll provide training. You can volunteer in person. We have some folks who are working remotely as well. The contribution of time, if you can give 3 to 6 hours per week during tax season, you'll be making a great contribution. And it's not year round. It's only from January to April. It's a short-term gig. And it's a very gratifying piece of work as well. So that's what I've got. I'm opening it to questions. I'm going to leave this slide up for a minute. If you have questions that occur to you as soon as you sign off, you can give me a call at that number in Concord, 224-2595, extension 230, or you can email me, Cary.Gladstone@graniteuw.org. And if the question is, can I be a tax volunteer? Yeah, we want to hear from you as well. And if there are other tax law questions, we'll do our best to answer them as well.
Well, I'm in the process of moving to Maine, so I'm afraid I probably can't be a tax volunteer. But I was wondering if so is the United Way in Maine going to be doing the same sort of thing, or do you know who to contact?
Yeah, I do. It's Janet Smith, and I forget the name of the organization, but you can probably Google.
Sure.
And I'll remember the organization as soon as we finish tonight. But once tax season is up and running, you can go to the IRS website, irs.gov, and type VITA, Volunteer Income Tax Assistance, VITA locator, and type in your zip code in Maine, and they'll tell you the nearest VITA site.
Thanks.
You're welcome. I'm going to stop sharing and see who else is still here. This is good. Tim, thank you for joining. A lot of times when I start speaking, people leave the room, so it's good to have people coming in and participating. Any other questions? Yeah, Amanda, how did things go?
That was a wonderful presentation. Thank you so much. It was very informative.
It was great. Thank you.
We really appreciate you.
My pleasure. Hope we'll see you at our tax site.
Sounds good. Thank you.
All right. Tim, good luck with the move.
Thanks.
Anybody else? Any last questions? Look at that. It's not quite 5 o'clock. So we covered everything there is to know about taxes. Okay, we gave you some basics in less than an hour. Thank you, everyone.
Have a
Thank
good
you,
night.
Cary.
You're
Take
welcome.
care.